I keep pointing this out in interviews is that if you go back and look at the history of gold since it became legal in the U.S., uh, eightfold moves. You had
Hmm.
a 50% drop from the $200 high when it was legalized in January 2000, 1975, collapsed to a low in 76 of 103. So a 50% bear market. Okay. Starting from that low in 76, it went up eightfold in 3.5 years, $850. Then in 2001 and 2, it bottomed again, this time at a higher level than it had been in decades before, $265. Took it 10 years, but it was an eightfold move, 1920. We
Hmm.
started from a bare low at 1,050. What's eightfold? About 8,500. Okay.
Yep.
So even if gold just goes to 8,500, which most people would think is ridiculous, it's only matching the geometric dimensions, the multiple gains that it produced in the prior two bull markets. In other words, it's only done it again, ordinary. I caution heavily when we get to the point where we think there's a correction. And I suspect if there's going to be one roughly midpoint on the clock, it's going to be late February, early March, probably at much, much higher prices for silver and for gold, but just it'll be lagged to silver. Okay. Uh, so I think there will be one, let's call it a month from now. Okay. And when
Hmm.
that occurs, we're going to caution people that if you're not leveraged and if you're invested in, just outright ownership of miners, which I think is a place to emphasize right now,
Hmm.
or silver, but it's unleveraged. If you choose not to flinch during the correction, that's fine, because the real problem with each of the corrections we've seen in this lethargic advance in silver has been that when it turns up, you don't get a chance. If you don't really astute, you miss getting back in because
Right.
it suddenly whap, you're back to the highs.
Right.
So one, it's important to get out right, and two, to get back in right. So it's really tricky because these corrections, if you go back and look at the archive, the action in 79 to 80 and to 10 to 11, boy, it was tough to get back in because when it turned, it just boom.
As prices climb, investors face choices: stay in, take profits, or reposition. Owning bullion and royalty watch mining equities without leverage is a prudent strategy when volatility spikes. Leveraged products can amplify returns, but they also magnify drawdowns in a correction. Unlike short-term trades, accumulating physical gold and silver aligns with long-term wealth preservation. Many Western currencies have lost significant purchasing power over decades, driven by money supply expansion and inflation. During major drawdowns, markets can reverse suddenly, leaving late entries chasing breakouts. Astute holders with physical metal avoid that trap and maintain exposure through market gyrations.
But remember, and this is something I've thought about myself and in part of the subscribers. When you get out of this trade, and this is not a trade, by the way, we're looking at money going up. This is not
Hmm.
some metals. This is thousands of year old money. Okay.
Right. Which
But
is
the
why I
other,
don't want to sell my ounces.
well,
I feel
yeah,
like that.
if you want to go to cash at the end of this, do that. But that cash is called gold or silver.
Right.
Okay. You want to go to a dollar, it's backed by nothing, just like the yen, just like the euro. They're evaporating in value decade by decade. You go look at an M2 chart and smack yourself in the face with some cold water when you look at it.
Hmm.
Every decade, it increases in quantity by about 80 to 90%, meaning it degrades by that much in terms of,
Yes.
when
Purchasing power.
when your dad built a house, it was 45,000. When your granddad, it was 4,500. And you want to build a new median house, it's 450,000. The degradation of money. So to put it into quote cash is a ludicrous statement. That's like saying I'm going to buy the dollar and watch it drop in value.
Yeah.
Okay. So put it in bullion, which you should already be in now anyway at this phase. Once you get that jiggle, especially, it's going to be a large multiple gain from here. So you don't need the leverage. Catching it in the first part, good idea. Got a lot of cash now. You caught that first move with some leverage or calls. That's great, super. You can go to the bullion now and relax and breathe calmly. But I think on the other side of this, there's going to be a new world. And I think silver's going to a new reality, meaning gold's gone to a new reality for 50 years. Look at the 80 peak, then look at the 2011 peak. And look where we are now. Those were eightfold moves,
Hmm.
each of those bulls. We're only fivefold right now from our bear low. So if we go to eightfold, gold to be 8,500, merely matching its prior two highs in terms of multiple gain. Silver was confined in a 50-year range all during that time. Why? Gold wasn't. Heck, copper wasn't. You know,
The idea of moving to cash amid uncertainty only makes sense if that cash retains real value. Traditional fiat currencies, the dollar, euro, and yen, have been steadily debased through decades of monetary expansion. By contrast, gold and silver have millennia of monetary history and resist erosion in purchasing power. Charts of broad money supply show relentless growth, underscoring why cash loses value over time. For investors focused on wealth preservation, shifting into bullion isn't speculation, it's protection. In a world of quantitative easing and low yields, gold and silver stand as tangible stores of value against eroding currency purchasing power.
I think it's quite valid or whatever, but when the market makes mistakes, and you know this being involved with the markets, whether it makes a mistake of being excessively overpriced, let's say the dot-com top, when it corrects, it overcorrects.
Right.
It has a tantrum the other way. So when the S&P went down from 2000 to 2002 in that bear market, the dot-com breaking bubble dropped 50%. NASDAQ dropped 82%, almost wiped itself out. It's overcorrected for the dot-com. And we've got anyway, silver has been the opposite. It's been underpriced relative to anything you want to measure, to gold, to the S&P 500. It's now just freshly broken out versus those other assets, versus gold, versus the S&P. So this is really something that just began in a big way, an asset clash. Silver's going to seek a new reality, and if that should logically be monetary factors factored in, let's say 300, I bet it overshoots it by a couple hundred.
Right.
In a tantrum. So that's why you can be a bit outrageous here. The reality should be logically and again, monetary factors out, the money supply growth, where should silver be? It might be 300 or something. So whatever it might be, I bet you overshoot it. And then you go back and live in the new reality.
Silver and gold aren't behaving in isolation. Markets everywhere are reconfiguring. Stock indices flirt with new highs, even as underlying breadth weakens, a classic topping pattern seen in past secular cycles. Major averages can grind sideways for months before decisive moves lower, much like 2000, 2002, and 2007, 2009 declines. During such broad market regime shifts, not all assets fall. In past downturns, bonds and gold rose as equities fell. Today's backdrop is different. Bonds may not be reliable havens due to rising yields and fiscal stress. In contrast, commodities and precious metals are emerging as alternative asset classes with renewed monetary relevance.
I think that's what's underway. I think it'll be quick. And then the issue you mentioned a while ago that I didn't address, stock market weakness. Right now, we think the stock market is topping. Last 3 months, we've been arguing it's got to continue up, though. Get above 7,000, which it did today, but probably even more. Probably at least get into February before it decides to roll over again. But we think it's a broad topping process of major proportions. It is going into a massive bear market when asset class breakage occurs, like in the T-bond market, the dollar stock market bubble breaks. But I don't see crash-like event based on technicals, which usually will warn you, oh gosh, you're breaking something big on the momentum. Then there it collapses. Momentum usually, we do have those structures in the S&P below, but they're far below. Requires getting down around 5,400 anytime this year. Well, heck, we're 7,000. So any break we have between now and then could be arduous, slow. Not a panic.
So kind of like 2022 is sort of what you're saying, where it was just a slow grind down from
or 2007 to 9. There was a crash event in the S&P, but when did it occur? a full year off the high. You made a
Right.
high in October 2007. You didn't have your puke event where you drop like 30% in a month, okay,
Right.
in weeks.
But it was
Yeah.
grinding down towards that puke
Yeah,
event,
it was
right? Yeah.
grinding, but it wasn't dramatic. In fact, it was
Yep.
still, most people were debating, is it really going down? We weren't, but I mean, most people were saying, because you'd have rallies that would impress. And I think we're in that position where, yes, you could top the stock market. But again, think about that. Let's say the stock market peaks next month, a couple hundred points above here in the S&P. And then you
Yep.
start to roll over, but it doesn't crash. It's arm wrestling. But at that point, you know, once you get out to April, May, and then you get into June, and only then is the stock market maybe even approaching the really danger levels where you could get speed. Where might the metals already be by then? Where might the miners already be by then?
Hmm.
Again, on the assumption that we're operating on, that we could have a sudden, by summer, highs that are dramatically above the current level. And I think that's going to be true for miners as well, by the way.
Silver has spent decades trading in a narrow range relative to gold and equities. But that regime has shifted. Breakouts against gold and equity indices indicate a new pricing dynamic. If silver were to reassert a fair historical relationship to gold and monetary forces, models suggest targets orders of magnitude above current levels. Markets often overshoot logically derived fair values during explosive moves. If silver's fundamentals, industrial demand, monetary demand, and constrained supplies, continue strengthening, price discovery could accelerate rapidly. What was once routine becomes extraordinary when markets acknowledge a long suppressed precious metals role in a transforming financial landscape.
Although every stock bubble we've had, you know, the 29 high, the 73 high, ended up with a crash at the tail end of that, by the way, at the tail end of the bear. And all during that time, gold was going up, by the way. And the 2000 top was arduous. I don't think there was ever a crash that you could define in that entire 2-year bear market, meaning in a matter of several weeks, you drop 30% or more. That's a crash.
Right.
Okay.
Yeah.
29 had a crash, but it was early in the bear. And by the way, all during the 29 to 32 decline, stock market got wiped out like 80%, 2.5 years. Okay.
Yep.
Gold went up all during the time. They were not legally because you couldn't buy it, but the gold miners, home stake mining went up like 1,000%. Okay. So, and again, the 2009 event, when that occurred in October, a year off the high already, gold and silver had already been advancing all during that time. And they suddenly said, oh, yeah, we're going to have a correction too. And they joined in. But what happened in November, after the October 2008 crash, Fed came in and did QE for the first time. They got the Japanese book and they did it.
Yeah.
What happened? Stock market kept going down till March. Gold exploded back to its high immediately.
Right.
Okay, so the Fed is a player here too, and we know what they're going to do, because especially we know what they're going to do when the new Fed chief comes in. Print, print, print. Again, that's blood for gold. It'll be, the world is going to split. Already the Chinese are, we know this, okay, and the Indians are talking about using silver or gold, okay. These are partial or whatever backing. Once the government bond market, this is not a crisis like 2000 to 2002, 2007 to 9. Those dealt with the dot-com bubble, and one dealt with mortgages primarily. Okay, this time it's government debt markets. We got the Japanese government debt market on fire in terms of collapse mode. We've got our bond market acting like hell. In fact, if you go another 2-3 points lower, you're going to see some of that. That's going to panic the central banks. They're going to cut rates, cut rates, cut rates. In stock market bear trends, gold almost always is a winner. Go back, look, 2000, 2002, 2007 to 9. Okay. In fact, through that, gold kept going up. It took till 2013 for the S&P to even get back to its highs of 2000 and 2007, both of which were in the mid 1500s. 2013, so you had 13 years with the same highs. Gold during that time went up, okay? So this connection of a stock market down, there's always a winner. All assets do not burn in a stock market decline. If you go back in history, gold has been the prime beneficiary. Usually T-bonds, also 2000, 2002, were a beneficiary. 2007 to 9 were a beneficiary. This time they're not. So if you're looking for that alternative, where do you go? There's only one place left. Well, actually, there's two. There's another one about to emerge. It's called commodities.
The broader backdrop includes stress in government debt markets and rising political polarization. Confidence in public finances, especially where debt is expanding faster than growth, is weakening global trust in safe assets. Central banks have few tools left beyond interest rate cuts and liquidity injections to respond to market strain. Historically, interventions strengthen gold prices as investors seek alternatives to depreciating paper assets. Political fragmentation in leading economies adds uncertainty to fiscal and monetary policy. Against this backdrop, gold and silver aren't just commodities. They become anchors of wealth continuity in an era of shifting economic paradigms.
I keep pointing this out in interviews, is that if you go back and look at the history of gold since it became legal in the US, eightfold moves. You had a 50% drop from the $200 high when it was legalized in January 1975, collapsed to a low in 76 of 103, so a 50% bear market. Okay. Starting from that low in 76, it went up eightfold in 3.5 years, $850. Then in 2001 and 2, it bottomed again, this time at a higher level than it had been in the decades before, at $265. Took it 10 years, but it was an eightfold move, 1920. We started from a bare low at 1,050. What's eightfold? About 8,500. Okay.
Yep.
So even if gold just goes to 8,500, which most people would think is ridiculous, it's only matching the geometric dimensions, the multiple gains that it produced in the prior two bull markets. In other words, it's only done it again, ordinary. We have extraordinary fundamentals out there. So where might gold go? At least to match the old highs, metrically, for a logarithmic scale.
So at least
but
85.
probably well beyond. And I don't have a target for gold, but here's my outcome. I don't think you end up with a bear market. I think gold becomes monetized. And once we in the Western world find out that we can't trust government debt markets, we can't trust governments, therefore, okay? We can't trust the stock market as an alternative. All of a sudden, we're left with one thing, and you create political chaos, as we're already starting to see. Democrat Party totally fragmented, moderate, radical left, fine. Republican Party now becoming totally fragmented. The Reaganites abandoned Trump a long time ago. Now suddenly, even many of the hardline Trumpers have called him using Gestapo tactics in the street in Minnesota. They've come down against it. So you've got to split. What if we have a third-party system here? Suddenly, minority parties start popping up that provide the extra 5 or 10% in order for the Democrats maybe to get a majority, or 5 or 10% extra for the GOP maybe to finally have a majority. You get the point. All kinds of changes like that could occur. I suspect there won't be a Federal Reserve.